Good evening, guys. Mic check and screen share check, please. Okay, let's go ahead and get started. This is the Saturday night nightly podcast for Tortoise Capital. So Saturday nights, we go through uh, market conditions and swing trade frames from Ken H. and other swing trade participants as a practical application of both the foundations course and the swing trading course. So if you are a student of those courses, you can post charts for review in Campfire and get some coaching and commentary. And we find that that's the best way to learn is learning in action. Geraldine, send me a note if you don't have access to Campfire. I believe I sent you the invites, but you know, life gets busy sometimes. We'll catch you up. I would note we're at the halfway point of the Creativity 202 course. That thing is exceeding all of our expectations. I had hoped that it would be excellent, and it seems to be great. And looking forward to tomorrow's session with the Euros and Monday's session with the U.S. Got an interesting lesson coming up. So we're going to first start off by looking at Chi Wing Chong's RL30 slope Z scores. I would be remiss if I didn't note that Chun Long said, hey, it's the best course he's ever taken. We're only halfway through, so wait till you see what the second half is like. It's going to be amazing. I appreciate that. You're part of what is making it great. I'm glad we had the foresight to record all of it to let other people build on the excellence that you're putting in there. So just want to thank you on behalf of the other students. So I explained last week in great detail how we do the regression line 30, the moving regression line 30, how we calculate the slope of that line, and then how we calculate the z-score of that line, and then use that to compare the z-scores of these different sectors, such as SPY, and then four of the most important subsectors. The technology, XLK, which is the long-term aggressive growth engine of the S&P, and then finance and materials, which tend to be cyclic in nature, meaning that they go in and out of phase around the S&P. So while the S&P is cruising along, there are times when finance and materials are doing better, and then times when they're not doing better. And it tends to oscillate as they go through the business cycle. And they can go out of phase too. Like sometimes finance will be in the lead, and then other times materials will be in the lead. Energy tends to go on its own cyclic nature, geared towards the price of oil, and that has an indirect effect on the pricing of the market and of materials and technology, which require energy, of course, as part of their ongoing costs. So you see that changes in the energy sector can be reflected in the other sectors. So like when you see the energy sector just getting smoked back in July when the price of oil went down, that actually fueled part of that recovery that happened after the spring meltdown. And then those tend to peak at statistically significant areas like 2 sigma, and then rolls over back to the zero line. So we care about the location of the z scores with respect to the long-term average, but we also care what the slope is and then where the turning points are to get some notion of possible inflection points. So as I'm reading this one right now, I'm noticing that there was a bit of an inflection point here and the potential recovery. Now, if you look at the charts, you realize that we are in a critical state at a very important support level for the 10-day, 30-day, and 150-day look back. That was preceded by a bit of a recovery. So we had a long run up. It sold off to that 150-day low, then had like a 2-day recovery. Just the fact of a little 2-day recovery, the failure to fail, was enough to have this bottom out and begin to recover. Now we know that the last 2 days of this week brought it right back down to that critical level. So what we notice then is that the overall slope is still down. It has the rate at which it was becoming panic selling was reduced. But the fact that the key factor is that it's below zero. So this doesn't mean that we're getting better directly. It simply means that the rate at which we were failing has slowed. Until it gets above the zero line, that price action is negative over the last 30 days. So, but again, the failure to fail has been helpful in that, and this is really the upward slope below zero is telling us is a critical state for the S&P and really all of the sectors, which are waiting to see what happens as we get closer to the elections. Now, what I said a form of this last night and have been saying this for a while, that you got the election here in November coming up, November 5th, and that we're about 20 days out from that. And the elections for the House and the Senate are so close that you're going to likely see lots of surprise news continuing to hit each day for the next 20 days, which is going to increase the volatility and the surprise. And you combine that with geopolitical problems in Ukraine and in the economies worldwide, and their increasing inflation and pressures on the energy complex and heading into what's going to be a cold winter. And you realize this is not a time to be swing trading, but really to take advantage of this increasing volatility. So we're going to see some short-term swing trading here that Ken H. has been doing. But those are really geared towards taking advantage of 1 or 2 day anomalies in price, and he's been quick to capture gains when he can. The bird in the hand is worth 2 in the bush now more than ever, and I would expect to see that to be the case all the way up through November 5th elections. So I am in no hurry to start taking longer term positions. And then the market conditions themselves don't really allow us to be taking exposures in the core holdings, which have been safely in cash for the last 6 months, which is we're pretty grateful for. So what I do want to say is that all of the sectors and the market have sort of converged on this -1 standard deviation location. They have there has been a little bit of buying pressure, hope, which is what created that support. But this is still clearly a very fragile market. Now, this next one takes a look at the comparison between XLY, which is the consumer discretionary, and XLP, consumer staples, compared to each other and to the S&P. And what's odd on this one is that in the middle of a bear market with lots of volatility and uncertainty, you would expect that the staples would do better, but they haven't. And I attribute that to an amazing rate of inflation, which may be suppressing some of those basic economic expenditures. And the one that's harder for me to understand is why consumer discretionary hasn't been underperforming that. That's really an anomaly. But its failure to improve here, which we can attribute to Home Depot and Tesla underperforming, which are 2 of the 3 biggest holdings The fact that it's flat while the other ones are slowly improving may be an indication that XLY is really going to start losing ground here. So we'll see how that goes. Not much more information on that one, though, to infer. So we're going to take a look now at Ken H's multi-time frame lens on. I think of what he's doing as hybrid swing trading, which I think is extremely appropriate for what we're doing. This is an approach that we've hammered out over the last 2.5 years of COVID, especially. We've been doing it for a while, but it's really proven its value in this bear market that we're in, because there are still opportunities to do things, but just in shorter steps. And so I say multi-time frame because he's looking at weekly, daily, and 65-minute, or think of that as hourly charts, a little smoother. And then looking for fractal patterns. And then you can see how these different time frames on a single screen give us insights about support and resistance. And we're looking for RLCO patterns, support and resistance, regression line fractals, trade locations based on look-back periods. So we're looking at these things in multiple lenses, looking for opportunities to frame critical states in shorter time frames. Now, let's. So this is Nucor. This is one of our steel companies that we tracked, and we're noticing that historically, this price is around 100 to 110 have been really important support levels that have triggered some amazing gains. And then peak prices around 140 have triggered sharp sell-offs, and we're kind of in the middle of a rebound off of this 105 that went all the way to 120, has pulled back. We see what that looks like, the move from 105 to 140, what that looks like. I mean, that's a 40% gain in about 3 weeks. And you'll notice that Ken H was able to get the PSAR flip here and a second position, which quickly scaled out of when it broke through the dragon and the PSAR flip. He looked at this one and then had to get it here with that wrist box to get short when this collapsing dragon broke support. Second position here, third position here. He considered a fourth position and then took the exit right here. So all three of those swings paid off handsomely. This was a stop and reverse, which he covered here when on failure to follow through, which is looking like a pretty good move. So now if we dial that down and look at the hourly charts, here's his 1, 2, and those were the two. Oh, I guess I'm sorry, it was just 2. I thought that was red. So those are the 2 places he looked at adding positions. He elected not to, just decided to manage those 2. Took the standard, like a Kata 2 exit right here. This exit is that exit. I might have been tempted in here, but he had such a nice buffer for this one that's still a reasonable move, and this is a stop and reverse. And then on the failure of the second effort to break through the emerging dragon, it didn't follow through. That's information. So when he sees the essentially collapsing dragon exit, he just takes that one. So here's a case where this shorter term swing trading on a relatively slow time frame, 65 minutes, well, that's slow for intraday, but it's pretty rapid for swing trading. This gives you that nice hybrid between, say, day trading or swing trading on daily charts and day trading on 3-minute charts. He's finding a nice hybrid in between at 65 minutes, where he's taking the elements of swing trade patterns and the aggressive position sizing and exit techniques of day trading with a nice blend. So that's a 65-minute chart. You say, is that swing trading or day trading? The answer is yes. it's very fast swing trading and very slow day trading, and he's making a nice, uh, taking nice advantage of that hybrid time frame. Because otherwise, you might think that there's a real significant difference between those two populations, day traders and swing traders, and you'd be right. So if you can straddle that time frame and use both of those frames of reference, you can get an advantage because of the synthesis. All right, so now he's got, we'll take a look at the Qs now, and you can see that they are already well below the weekly support level of 285. They've even broke through the previous absolute swing low, and then and then held. So here's where that this swing low is that one, and then this swing low is that one, and this little bounce up and back down is this little bounce up and down. So this was failure to get through the top of the dragon, and it rejected the bottom of the dragon and fell over. That's what this was. It was an effort to break out, and it couldn't, so it comes back to test. So let's take a look at his little trades in here. He gets a nice entry, adds a second position. The gap down was problematic, so he had to take a micro loss on this one. This one paid for it, but that becomes a stop and reverse. On this collapsing dragon, he gets a second position in. On this collapsing dragon, he decides, do I want a third? He says, no, I'll just go ahead and manage it. So he waits for this one and says, I'll get my third one here. By this time, he's ready to test this entry, and because of the gap, he says, I have to take a loss on this one, which negates that one. So he gets the win on this one, but that willingness to hold for that extra piece just ran into a gap, and that's the one thing you got to watch on swings. That's different than the day trade, is the possibility for that gap. That's a stop and reverse, which scratches. It looks like, or, oh, yeah, I think he's short here. Should be. And now we've got this little risk box. Does it hold here? If it does, it might do that. If it fails, it could be large because it's already broken through all of the previous support. So this thing could collapse like a maniac. So this is a good position to be short from 280 on a single position. Would expect to see fireworks on Tuesday. If we go back a little further, we can track some of his other swing trades on this one, which have been paying off pretty nicely. The intraday SSCs and Kata 2s gives him this trade with a nice exit here. This one pays off. This one is a micro loss. This one pays off huge. Quick scratch, stop and reverse, pays off. Quick loss. This one pays off to here. And looks like this one is still in the money. Yeah, that one's in the money. So he's done a really nice job of trading this volatility on both directions. So he's agnostic with respect to direction, and that's the mentality to have in a bear market. Excuse me. Devon Energy is another one of our favorite traders here. Let's see. He gets a quick scratch, gets a long second position, third position. Third position scratches, but both of those pay off beautifully. This one reversed quickly into this position. So, naturally he's kicking himself for not taking that exit in here. But, to be fair, he's got room, and there was reason to believe here that this could fail, but then the gap got him, so he just makes bank on that position instead of where he might have gotten out of. the markets have been so volatile, and I sort of also understand why not taking those extra positions. It's probably a portfolio heat issue altogether. But we do see him here with a stop and reverse and crushing this. And I would have my stop at 71 on this because that's the last place that this thing collapsed. I think there's every reason to believe this thing's going higher because of the agreement between Saudi Arabia and Russia to reduce oil production by 2 million barrels a day as the impotent Biden looks on with no ideas that are his or anybody else's for that matter. So this is one that could really continue to go. So he's in great shape on that one. This is XOM, ExxonMobil, and he's been trading this one. This one, you notice the incredible cycling on the weekly. Micro loss, stop and reverse, cap. This one trade here pays for both of those losses easily. This stop and reverse, he gets a second position this time above the swing high, which to me is sensible, because when you see just how volatile this thing has been, this is not the kind of moves that make me want to just routinely add positions. I would just as soon have this one with a nice risk box and let it ride until it clears that previous trading range, which has been so problematic. So now he's got two. He's holding from 101 and 86, and that is 14, 15 plus 7. That's an average price of about 93. So he's got a real nice buffer for his two positions there. And you can see how those are holding. And then he's got a nice plan for an exit around 100. If that doesn't work right away, if this starts collapsing, then you got to get out here. Otherwise, you might eat those kinds of sharp moves downward. So I like that position. It's poised to be massively good. This is Credit Suisse, and this was a Godzilla pattern last week when everything had bottomed out near the bottom on the weekly and the daily. He gets a short position here, stop and reverse. So with the move here, he's about with the price here, and he's got to balance that loss against that gain. He's about market neutral, but this has every reason we would think to get back to 5.5. I think he's in pretty good shape there. We'll see how that one goes. This is AMD in the semis, and why these things are getting smashed is hard for me to understand. I would think that U.S. semiconductors should be benefiting from what has to be a massive government boost for domestic production for national security reasons, and these guys should be well positioned to do that. But he's got a short position here that's in the money. I would watch that one closely. If we see signals that market's going down sharply, then this should continue to get smashed, and you're going to be fine. But if we see in the futures market on Monday night some gains, I would be ready to get out of this because you would expect semis to benefit. You can also see that there were plenty of opportunities here and here for collapsing dragons to take advantage of the short side. They have been very fluid in both directions, and this is why we want to pay attention to that pattern when the PSARs flip and the dragon rolls over, and especially when you see the RL10 go from fall to winter. This is the sign of pain and suffering ahead. So AMD still in play. GRIN, Grignard Shipping, so an industrial sector for transportation, has been in a holding pattern halfway between the peak and the valley. So this makes this on a weekly basis a critical state. Anything above 25 should be long. Anything below 23 should be short. You can see that sideways quiet channel developing. Now notice the winter, that's all the red, and then the spring, and then it got better here after the PSAR flip became summer, but it has not been able to hold on to this momentum, and instead we've had 15 days of just chop. So that's why it goes from the summer into the fall. So that makes this, excuse me, especially vulnerable. And that vulnerability would first happen if it breaks out of this box, and then if it breaks below these support levels, you'd add a second position. If it breaks out of the daily low, a position. If it breaks below the, I'd add one here and add one there. So that's what your price ladder to the downside looks like. Key prices here, 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 and here, with a target all the way back to here at the 10-day low, which is $20. If $20 fails, you would expect to see it get to 19, 18, 17. So this is a dollar. All the ones after this, the logical steps are a dollar. So this thing could really fail big. The fact that it hasn't gained in 30 days tells me this feels like a lid that's been placed on it, and that lid is lower than this one. So to me, that doesn't feel sustainable. We may have seen the best of it already. So I would especially be ready to play this short. The upside, if it breaks above 25, looks to me like it's capped around 27.50. So that's about a 10% gain. So you could play that for sure. But to me, the easier money would be on a collapse of global shipping and an economic slowdown. So we'll see how that goes. That's a good frame right there. CCRN is Cross Country Healthcare. Is a service provider. And what we've got on this one was a COTA 2 entry on the PSAR flip. This rolled over. He elected to just take it. There was an opportunity here on the PSAR flip, but the fact it's come back in here, this feels like pretty toppy action, like there's a limit on it at 32. So I would be looking at this risk box, again, both ways. It's a tight compression here, about $1.50, and there's $3 to the upside, so that's 2 to 1 to get back to 35, and 2 to 1 to get back down here into that support level. And then if this broke, you could get another position because it's going to come to 24.50. So I like that in both directions, but I would prefer to trade the downside, especially in this bear market. Good looking frame. Dexcom Healthcare, also in the healthcare sector, had just an extraordinary earnings, completely broke out of all of this, has almost made it back into the previous support level around 110, or the fair price, breaking out in this range from 80 to 95, has run way up and is now closer to that magnet than this magnet. I like the breakout here. If there's no new buying pressure that can come in, then this fails back to here pretty darn quick, and that's a 10% fail. But if it does break out, say, above 103, then there's a good shot at getting above 105, and if you only got a 50-cent risk, you have a nice, you have a 2 to 1 multiple in here, and then if it breaks out, this could really go. So that looks to be interesting as well. That's one that was found from a one-day, both the one-day and a 5-day volatility. You can see how big the one-day move was, and then the 5-day move is like that. So it's extremely volatile on the 5 and on the 1. So that double volatility, 5-day and 1-day, makes this a volatility play, and those are typically well framed in either direction as a breakout. Increased volatility like that just means that both sides are in an emotional state. and you just wonder who runs out of emotion and belief first. The other guy wins. So we'll see how that goes. All right, so this is CVS. This was an earnings smash. It had been stuck in this declining pattern here, and the normal expectation was that it would roll over and just flop around in here. Instead, big gap down, harsh sell-off to here, and all of this goodwill is gone, and it's well below the support level at 91, which is now resistance to the upside. So this breakout here, you would play with the idea of getting to 90.50 or 91. That's about a 50-cent risk. So you get about a 2-to-1 to the upside. But the breakdown would really be something here. This would be, there's your price on the weekly. And notice it has already broken through those crucial levels. And so you think if it does fail, it could get back into this cluster here, which is around 84. That's $4 to the downside. That's what a Godzilla looks like. It's at the bottom of the 10-day, 30-day, and 150-day look back and has extraordinary volatility. So it is enraged and ready to rock. Nice move. Tesla has just been disappointing as Elon just gets diluted in all of his other little shenanigans, and Tesla has just been smashed from 310 all the way back down to 220. That's minus 35%, Elon. Quit monkeying around with spacesuits and robots and Twitter wars with idiots. So that's what a shareholder would say. Extraordinarily large 5-day range from 290 to 220. Holy mackerel. And then a 1-day range that fought all the way down and closed poorly. If you're a fanboy, this is really harsh. And I think you can play in either direction. It's the most important stock there is, but he's at a crucial support level that if that breaks, all of that previous goodwill is gone, and he's back to trying to make money selling cars, which he hadn't actually been able to do very well. The promise is there. The potential is there, but people need to see some cash money on the barrelhead. That's ready to go in either direction. Keep following. XPEV is Chinese electric car, the Chinese competitor. They have been affected by the economic slowdown going from 35 to 10. So if you thought Tesla's slide was painful, that's a minus 70%. Can the Chinese government afford to let them go out of business? No. How far can it fall? I don't know. But at some point, you're going to see some sovereign wealth funds coming in and buying this thing. And I would trade this purely on a tactical basis or a political basis. And you have a lot of buffer built into this thing. So it may very well be, as a Godzilla, an opportunity to slowly, tactically trade it intraday. It looks like there's enough volume to do it. We'll wait and see the Chinese government start pounding that thing. DBMF, a managed futures strategy. So these are just active traders, professional traders, and they've had a couple nice Kata 2s. Another Kata 2 here have come into the consolidation zone, one step away from 34. So that's a 50-cent move. You're talking about a 10-cent risk box. So that's 5-to-1. And to the downside, there's a 5-to-1. Not sure how liquid this is, but it certainly is interesting. That's not one that's going to respond directly to news and economic pressures. It's really just a function of the internal psychology of the holders of that fund. So caution on that one. It's a pure statistical play. But I look at that as a breakout ready to happen in either direction. You could trade it on a technical basis. I'd rather play the other ones that I think are safer, to be honest. UNUM Financial Services Company, life insurance. They've had a nice boost on the weekly and closed very well. So you got to believe that a breakout to an all-time high, you could do worse than giving that a shot, I think. I would rather play the upside. The downside is unlikely. It has to break through 41 really to be persuasive. I suppose you could get short right here. But if you don't, you have to get short here if you're going to trade this at all, because that is not support. That was just a gap up and go. So the target is this cluster down here. That's the first place you'd see buyers coming in. The same people who bought it all the way up came in right here. So to me, 41's decisive if you're going to trade that one. L3, industrials and space. I actually like this one as a fence sitter. Here it is, stuck in the middle, halfway between disaster and heaven. And it closed very well on two really weak days in the market. This thing did nothing but go up. And I like him to the upside with increased global tensions. They do L3 gets big-time government contracts for defense, and now's the time to be in that business. So if this does break out, you think it can get to here. It has to get above 234 for me to want to put a second position on. I like it in either direction, though. But I would prefer the upside. And then finally, PCG, Pacific Gas and Electric. This must be a natural gas. There's your PSAR flip. When it broke above the emerging dragon and then some Kata 2s in here, wonderful trade from 12 to 15. That's a 25% gain. And now the pullback to preserve those profits held support and is starting to roll higher. There's your risk box. Either direction, you like it. It's going to continue to be volatile, but you got to like the fact that it's so far above any previous resistance. There's no reasonable upper limit on it. Okay. All right, that's everything we got for tonight. We'll get this published and posted, and appreciate your kind attention. And looking forward to the creativity folks in the morning and on Monday. And would encourage people to consider that as a long-term commitment to your cognitive development. That course will work on you at the DNA level in ways that you don't even realize until you're into it, and suddenly you have such a variety of different points of view that it's staggering. It's hard to explain, but I see it in myself too. Ever since designing that course, I've just been better at everything I've done. Phenomenal. All right, take good care, guys, and we'll see you tomorrow.